Here's a question. What did you eat last week? A coffee and donut on your commute? Wings at a sports bar? A quick sandwich delivery? Chances are, you consumed something from one of the 33,000 restaurants owned by a single company. Yet I'd wager most of you have never heard the name Inspire Brands. That changes today. On May 8, 2026, the world's worst-kept secret finally became official. Inspire Brands filed confidentially with the SEC to go public, and they're not asking for pocket change. We're talking about a $20 billion valuation, seeking to raise roughly $2 billion in what could be one of the largest restaurant IPOs in history. Think about that for a second. This isn't some flashy startup that disrupted the market with an app. This is a company that owns 6 of America's most beloved restaurant brands. Brands you probably visit without even realizing they're all under the same roof. They've built an empire so quietly, so systematically, that most people have no idea it exists. This is the story of how a private equity firm orchestrated one of the most brilliant consolidation plays in restaurant history. And honestly, it's worth understanding, because it tells you everything about where the food industry is headed. Let's rewind to February 2018. A private equity firm called Roark Capital, founded by Neil Aronson back in 2001, had a vision. They looked at the restaurant industry and saw something most people missed: fragmentation. You had incredible brands, each operating independently, each missing out on economies of scale, shared technology, and collective power. So Roark asked themselves, what if we built the Hilton Hotels of fast food? Think about what Hilton did. They didn't try to make every hotel identical. Instead, they created a portfolio. Hilton, DoubleTree, Waldorf Astoria, Hampton Inn, each with its own identity, but all sharing the same backbone of technology, supply chain, and operational excellence. That's exactly what Inspire set out to do in the restaurant space. They started by acquiring Arby's and Buffalo Wild Wings. That was the foundation. 4,600 restaurants across 2 completely different concepts. One, a roast beef sandwich chain, the other a sports bar empire. But here's the genius. They weren't trying to merge these brands or make them the same. They were building a platform that would let each brand thrive while benefiting from shared infrastructure. This wasn't a quick flip. This wasn't a typical private equity play where you buy, cut costs, and sell. This was a long-term vision. Roark Capital had built its reputation on patient capital, on understanding that the restaurant business, especially franchising, rewards those who play the long game. They were playing chess while everyone else was playing checkers. Once Inspire had the foundation, they went on what can only be described as an acquisition spree. And I mean aggressive. December 2018, they acquired Sonic Drive-In for $2.3 billion. Now they own the largest national drive-in chain in America. That's 3,500 locations added to their portfolio overnight. October 2019, Jimmy John's, the #1 owned delivery sandwich brand in the United States. Another 2,800 locations. Then came the big one, December 2020, Dunkin brands for $11.3 billion. This wasn't just a big acquisition, this was one of the largest restaurant deals in history. Suddenly, Inspire owned the 5th largest restaurant chain in America. Dunkin alone brought 14,000 locations to the table. They also got Baskin-Robbins in that deal, adding another 8,000 ice cream shops globally. In less than 3 years, Inspire went from 4,600 restaurants to over 30,000. They went from a regional player to a global powerhouse, operating in 57 countries. Now here's where it gets interesting. When you're acquiring at this pace, you're not just buying restaurants, you're buying complexity. You're buying different supply chains, different technology stacks, different corporate cultures. Most companies would have imploded trying to integrate all of this. But Inspire didn't try to integrate everything. Instead, they built something smarter, a shared platform. Shared technology, shared data infrastructure, shared innovation centers. Each brand kept its identity, its menu, its marketing, but they all benefited from the collective scale of the enterprise. It's the difference between a holding company and a true operating platform. And that distinction matters, because it's what made this work. Here's what most people don't understand about Inspire. The restaurants aren't the real asset. The data is. Think about it. Inspire operates 33,000 locations across 6 different brands. That's 650,000 employees. That's millions of transactions every single day. Every order, every payment, every customer interaction generates data. And Inspire built a unified technology platform to capture, analyze, and act on all of it. In 2021, they opened their innovation center in Sandy Springs, Georgia, a 15,000 square foot facility where they test new equipment, design improvements, robotics, and modular kitchen stations. They're not just running restaurants, they're optimizing them at scale. They also opened a ghost kitchen in Atlanta, the first one launched, owned, and operated by a multi-brand restaurant company. Why? Because they have the data to know exactly what products work, what delivery times customers will tolerate, what price points optimize for profit. By 2023, they opened an innovation center in Hyderabad, India, focused on data engineering, data science, analytics, and AI. This isn't a restaurant company that happens to use technology. This is a technology company that operates restaurants. And that's the real moat. That's what makes Inspire different from every other restaurant holding company. They've built something that gets smarter the bigger it gets. The more data they collect, the better they optimize. The better they optimize, the more efficient they become. The more efficient they become, the more profitable they are. That's a flywheel. And that's what's worth $20 billion. So why go public now? Roark Capital built its reputation on not exiting. They're known as patient capital. They hold for the long term, but things change. First, the market is ready. We're seeing a stronger pipeline of IPOs in 2026. Private equity firms are increasingly looking to public markets for exits. The timing is right. Second, Inspire has reached a scale where public markets make sense. They're generating $33.4 billion in system-wide sales. They have $11 billion in U.S. digital sales alone. They're operating profitably across multiple brands with proven unit economics. That's the kind of scale that attracts institutional investors. Third, going public doesn't mean Roark is abandoning the strategy. It means they're bringing in new capital partners. Public shareholders will benefit from the same technology-driven optimization that Roark has been building for 8 years. But here's the real story. This IPO signals something bigger about the restaurant industry. Consolidation is winning. The days of independent restaurant empires are fading. The future belongs to platforms, companies that can aggregate brands, share technology, and optimize at scale. Jersey Mike's is also filing for an IPO. Wingstop went public back in 2015, and that was a Roark Capital play too. The pattern is clear. The winners in this industry are the ones who can build platforms. For investors, this is a chance to own a piece of something genuinely unique. You're not just buying a restaurant company. You're buying a technology platform that happens to serve food. You're buying a portfolio of iconic brands that have proven resilience through economic cycles. You're buying exposure to 33,000 locations in 57 countries. And for those of us watching from the outside, this is a reminder of how capitalism works at scale. A smart idea. The Hilton Hotels model for restaurants, combined with patient capital and disciplined execution, can create a $20 billion company in 8 years. That's the real story here. And if you want to understand where the food industry is headed, pay attention to what Inspire does next. If you found this breakdown valuable, please like this video and subscribe to Business Undercurrent. We cover the business moves that reshape industries every single week, the strategies, the consolidations, the quiet plays that define markets. Thanks for watching.